The put credit spread option strategy is a bullish option strategy with limited risk and a high probability of success. The profit potential and risk of a put credit spread is known upfront before you enter the trade and is suitable in a small trading account due to the flexibility of setting up the strategy. And later in this video, I will talk about how to trade this strategy in a small account. In this video, you're going to learn everything you need to know about the put credit spread strategy, and I'm going to teach you the strategy with numerous trade examples and P&L graphics so you can fully understand how the strategy works. You can download this entire presentation for future reference in addition to my other bonus PDFs in the link down below. And before we get started, I just want to mention that if you're ready to move on before I am, feel free to use the chapters down below to skip through the various sections. What is the put credit spread option strategy? The put credit spread is shorting or selling a put spread, and this is a position that is constructed by shorting a put option and then buying another put option at a lower strike price. The outlook of this strategy is bullish. So in this little visualization here, we can see that if I were to short a put option with a strike price of 105 and buy a put option with a strike price of 100, this would create a put credit spread strategy, and this position would make money as long as the stock price remains above the strike prices of this put spread. Every option strategy has a bunch of different names, and the put credit spread is also known as a short put spread and a bull put spread. So for future reference, if you hear these other names, they are all referring to the same strategy. The maximum profit potential of the put credit spread is the amount that you collect when selling the spread. So for example, if we enter a spread with a price of $3, that means we are actually collecting $300 into our accounts, and that will be the max profit of the spread. The maximum loss potential is the width of the strikes minus the amount we collect for the spread times 100. So for example, if we sell a $5 wide put spread, such as the one in the previous slide, and we collect $3 for the spread, our maximum profit potential is going to be $300. And in this scenario, the maximum loss potential would be $200. And that's because an option spread can only be worth the width of its strikes. And if we sell this spread for $3 and its maximum price is $5, our maximum loss potential is $2 in terms of the spread price, or $200 in terms of the actual P&L. Here is an example risk graph of a put credit spread. This simply shows us what we can make and what we can lose at various stock prices right now, in the future, and at expiration. In this example, we are looking at a put credit spread with strike prices of 240 and 230. So we are shorting the 240 put and we are buying the 230 put. The stock price at the time of entry is $250. The spread entry price was $2.60. This brings our max profit potential to $260 and our maximum loss potential to $740, since this is a $10 wide spread. If we collect $2.60 for it and it goes to a max value of $10, we will lose $740. The break-even stock price at expiration is $237.40. This means that if the stock price is at $237.40 at the time of expiration, the spread price will be $2.60, and therefore we will not make or lose any money. The key takeaways here is that the put credit spread, or bull put spread, makes money when the stock price increases or remains above the spread over time. And the position has limited risk in the event of a stock price crash. So this white dashed line is the stock price at entry, which is $250. And this blue dashed line is the expected P&L on the date of entry. We can see that if the stock price starts to go up, we will start making money on this put credit spread strategy. And if the stock price goes down, we will start to lose money. These other green and red lines represent the expected P&L in the future. So specifically, this green line represents 30 days to expiration. And since we were simulating a position with 60 days to expiration at the time of entry, this green line represents the expected P&L of the strategy 30 days into the future after entering the trade. We can see that as time passes, if the stock price stays the same, this position will start to make money, and that's because the spread will lose value since both of these put options are out of the money, and that means their option values will trend to zero over time. And since we are selling this spread, we want its price to go to zero, and the spread price will reach zero if the stock price is above the short put strike price of 240 at the time of expiration. So we can see our max profit is $260 when the stock price is above 240 at the time of expiration, and our maximum loss potential will occur if the stock price is below 230 at the time of expiration. So here we can see that it doesn't matter if the stock price goes to 230 or to 200 or to zero, our loss potential is limited to $740 for this specific position. So when is the optimal time to enter put credit spreads? Well, since it's a bullish strategy, the optimal time to enter a put credit spread is right before a stock's price goes up or while a stock's price is in an uptrend. But here is a specific example in IWM of a potential trade that we could have taken based on support and resistance levels. So here I'm looking at the support level of 170. We can see that once IWM came down to this support level of 170, the stock price chopped around a little bit and then rocketed higher. Let's say that as IWM came back down into that 170 price level, a trader believed that the support level would hold, and so they wanted to play it with a put credit spread strategy. The way they could do this is they could sell a put option with a strike price of 170 or right at that support level, and then they could buy a put option with a strike price of 160, which is $10 below the short put strike price. And this would create a $10 wide put credit spread. So if we go to the next slide, we can see the actual performance of this trade. And we're looking at the 170-160 put credit spread. The spread price at the time of entry was $263, and this brings our max profit to $263 and our maximum loss potential or margin requirement, which is the amount of money we need to put up to enter this trade, of $737. The expiration was April 2023. It was the standard monthly expiration cycle, and we had 46 days to expiration at the time of entry. As we can see here, IWM traded down to the 170 price level, and the put credit spread actually had very small losses at the time of IWM coming down to 170. That's because the stock price decreased from the time of entry and the spread price increased a little bit. When you sell a put spread, if the put spread value increases, which is going to happen when the stock price falls, you will start to see losses on your position. But fortunately, as we can see, IWM bounced from that support level and stayed above the 170 price level over the remainder of the trade. On the bottom part of the graph, we can see that the P&L of this put credit spread position started to trend higher, and at the time of expiration had the maximum profit potential of $263. And so at the end of the trade, since the max profit was reached and the trade reached a $263 profit, and since we had to put up $737 to enter the trade, our return on capital for this position would have been a positive 36%. So this is why put credit spreads can be very attractive. It's because you can make money so long as the stock price remains above a price level, and you can have a very high return on capital for that particular trade. Now let's go over an unprofitable put credit spread position that was entered at a relatively risky time. We're going to go back to IWM, but instead we're going to enter a put credit spread when IWM is around $195. As we can see here, IWM previously came up to the 195 to 200 price level and sold off aggressively. And so we're going to say we enter a put credit spread here, and we're going to use the short 190 put and the long 185 put. This is going to create a $5 wide put credit spread. As we can see in this chart, on the top we're looking at IWM's price versus the credit spread strike prices. On the bottom part of the graph, we are looking at the P&L of this position. The spread price at the time of entry was $1.20, and that means our max profit for this position was $120. And since this was a $5 wide spread, if we sell a spread for $120 and its max price is $5, that means it can go against us by $3.80. And in terms of P&L, that means a $380 loss. So the max loss in this particular position is $380, and that is also the amount of money that we have to put up to enter this trade. As we can see, IWM did trickle lower and traded between 185 and 190 for a period of time. And then in the final weeks before expiration, IWM absolutely collapsed, and this put credit spread ended fully in the money, which means the stock price was below both of the strike prices of this put credit spread. And on the bottom part of the graph, we can see that unfortunately, This put spread went to the maximum loss potential of $380 at the time of expiration. And that means the return on capital here is a negative 100% since we put up $380 to enter this trade and we experienced a $380 loss. Let's compare the P&L performance to simply shorting a put. So I recently did a video on selling put options. You can watch that in the link down below. But let's go ahead and compare a put credit spread to selling naked puts all by themselves. This is the same exact chart from the previous slide, except on the bottom part of the graph, I have plotted the put credit spread P&L, and I have also added the short puts P&L on its own. So this would be the short 190 put option as opposed to the put credit spread. And so we can see that while the put credit spread reached a maximum loss potential of $380, if we were to only have shorted the 190 put at that same time, that trade would have lost $1,500 over the same exact period. And this is why put credit spreads are so much safer than selling put options all by themselves. When you sell a put spread, you have limited risk. Doesn't matter if the stock price goes to zero, you are going to have the same loss potential as compared to if the stock price is just below your put spread strike. However, when you sell a put option all by itself, you will lose more and more money as the stock price continues to collapse, and so you will have far more loss potential when shorting put options all by themselves. Now I want to talk about why a put spread's maximum value is the width of the strikes. So I've created a simple visual here. Let's say I short the 190 put and buy the 185 put, and the stock price collapses all the way to $100 at the time of expiration. What this means is that the 190 put is going to be worth $90 at expiration since the stock price is $90 below its strike price. And that means the 185 put is going to be worth $85 since the stock price is $85 below its strike price. If I pay $90 to buy back the short 190 put, that means I will pay $9,000 for that option. But since I own the 185 put, if I sell the 185 put for $85, that means I will collect $8,500 into my account for selling that put option. And that means since I paid $9,000 and received $8,500, the net payment I make to close this put spread is $500. And if I initially sold the spread for $100, that means my net P&L is negative $400 since I collected $100 initially to sell the spread and I had to pay $500 to buy it back at the time of expiration. And so that's why the width of the strikes is the max value of the spread. It's because it doesn't matter where the stock price is. If it is below both strike prices, the difference in value between those options is going to be the width of the strikes. In terms of exercise and assignment, I know a lot of traders worry about exercise and assignment when seeing a put spread or call spread get fully in the money. So if a fully in the money spread is held through expiration, the exercise and assignments will actually offset. So if you do have a fully in the money spread at expiration and you hold it through expiration, you will not end up with a stock position. And that's because if you get assigned on the short 190 put, which is going to happen if you hold it through expiration, that means you will buy 100 shares at $190. However, if you hold the 185 put that you own through expiration, it will automatically be exercised, and that means you will sell 100 shares of stock for $185 per share, and that means you'll buy shares at $190 and you'll sell them at $185. Therefore, you will take a $5 loss per share. If we multiply that by 100 shares, we get a loss of $500. And again, since we sold the spread initially for $100 in premium, and we allow the spread to expire fully in the money, and we realize that $500 loss from the transactions I just described, that means our net P&L would be negative $400. So based on these two scenarios, it doesn't matter if you buy back the spread at expiration or allow it to expire in the money, your loss is going to be the same. Now let's talk about strike price selection and setup. I want to talk about the different risk rewards that you can get in addition to the probability of making money when setting up put credit spreads with various strike price setups. If I open up the Tasty Trade trading platform and go to IWM, which is the Russell 2000 ETF, we can see that IWM is currently around 171.85. I'm going to go to the trade page and I am going to open up the December options with 38 days to expiration, just as an example. And to create a put credit spread, I will have to short a put option and then buy another put option at a lower strike price. For this example, let's use the 170 put for the short strike. So I'm going to click on the bid price of the 170 put, and then I'm going to create a $5 wide spread, which means I'm going to click on the ask price of the 165 put. This queues up an order for the 170, 165 put credit spread expiring in 38 days. We can see that the spread price is $1.37, and we can see that the platform is telling us the max profit is $137 if we sell the spread for $1.37. The max loss is the width of the strikes, which is $5, minus what we can collect for this, which is $1.37, times 100, which gives us a max loss of $363. We can see the buying power effect says $363, and that just means we need $363 of available capital to enter this trade. Since our maximum loss potential is greater than our maximum profit potential, this means that this position has a high probability of success. Anytime in trading, when your loss potential is greater than your profit potential, that's because the strategy has a high probability of making money. And this trade has a high probability of making money, specifically a higher than 50% chance of making money, since the stock price is at around 172 and we are selling a put credit spread, which makes money as long as the stock price remains above 170 through the expiration in 38 days. But let's say I wanted to create an even higher probability spread. The way I would do that is sell a further out of the money spread, specifically by moving these strike prices lower. But let's see what happens to the spread's price when we do that. Specifically, let's set up the 168 short put, and let's keep the $5 width the same and move the long strike down to 163. Now we are selling the 168 put and buying the 163 put, and we can see that the spread's price is trading for $1.09. And so since we move the spread further out of the money, we are going to collect less money for this position since it has an even higher probability of making money. And this means that our maximum loss potential will go up as well. And so the takeaway here is that the further the strikes are out of the money, the less the spread is going to collect. And that means the position will also have higher loss potential. And now let's look at expanding the strike prices to see what that does to the spread's price. Before, we looked at the 170, 165 put spread, and we can see that this spread has a price of 136. But what if we extend the width of the strikes to $10? So instead of buying the 165 put, we will buy the 160 put. Here we can see that we are going to collect $2.13, and our max loss goes up to $787. So by selling a wider put spread, we will collect more premium, but since a wider put spread has a higher maximum potential value than a narrower put spread, we also increase our maximum loss potential. Let's compare these spread prices to see if there is a similarity between their risk and reward. For this spread, let's just divide the max loss of 364 by the max profit of 136. 2.67 means that we have 2.67 more loss potential than profit potential. Let's see what the ratio is if we go to the 170, 160 put spread. Now we can make 212 and lose 788. So if we do 788 divided by 212, this comes out to 3.72. So with this $10 wide put credit spread, we have loss potential that is now 3.7 times the maximum profit potential. And what this means is instead of expanding the strike width to increase the size of the trade, instead we could just simply sell more contracts of the $5 wide spread. And for me, this would be a better way to scale the trade as opposed to increasing the strike width, because the 170, 165 put spread has a better risk to reward ratio. I mentioned earlier that this strategy can be set up to require very little money to enter the trade. And so let's look at what that means. Let's look at selling the 170 put in IWM and buying the 169 put. We can see that this spread is $1 wide, which means its maximum value at expiration is $1. And we can see that the entry price is 33 cents. which means the max profit is $33 and the max loss potential is $67. So by using put credit spreads with very narrow strike widths, you can trade with a very small amount of money and have very minimal loss potential. When it comes to managing a put credit spread position, as with any option position, you can close the position before expiration by executing the opposite trade that you did when entering the position. For instance, when we look at this IWM put credit spread, where we shorted the 170 put and purchased the 160 put, to close this position, we could buy back the 170 put and sell the 160 put, and that would close our put credit spread position. In this specific example, we can see that the trade got up to a $200 profit, but still had around 15 days to expiration. And since the max profit potential on this trade is $263, and since the trade reached a $200 profit, which is most of the maximum profit potential, and still had 15 days left until expiration, a trader could have simply bought back this put spread and they could have secured that $200 profit. So you don't have to hold put credit spreads all the way to expiration. Like any option position, you can close the position before expiration by doing the opposite transaction that you did to enter the trade. And for a put credit spread, that means you're buying back the put option that you shorted and you are selling the put option that you purchased. And you can do this in one transaction, just like you did when entering the trade. If you have any questions about this strategy or video, please leave your comment down below and I will answer your question as soon as possible. Again, you can download this entire PDF in addition to all of the new PDFs that I'm creating for every video going forward, and you can download those in the description below. My name is Chris from Project Finance, and I will see you in the next video.